Hey everybody, we'll look at chapter 17 today, and I'm going to use the PowerPoint that is out there in the content. I'll just look at this video and just take notes from this. But this is a video, this is a PowerPoint that is from another textbook because it does a better job of explaining the income tax chapter than the others, or than Pearson does. So as we go through here, I'm going to make some notes just like I normally do when it's live. You're not going to be able to see my face, which is probably a good thing. But in the comfort of your own home, you're able to maybe learn even more of this method than you would have in class. Because once you go through this, if you want to review it or stop and back up, you can do that. So let's just go ahead and look at the chapter on income taxes. Now, I know income tax may not be your favorite topic, but this chapter is not about the code itself and how to fill out forms. So this is a corporate tax, sort of a preview to what you'll do if you do the MAC here at ETSU when you get to corporate taxation. This chapter is all about how do you record the difference between income tax payable and income tax expense. Now, income tax expense is GAAP, financial statement presentation, accrual basis of accounting. We record income tax expense when the income is earned. Income tax payable, on the other hand, is a term used to set up an accounts payable for actually remitting cash to the IRS. So that payable that we're paying the IRS isn't always the same as what you have with income tax expense. And therein lies the issue. You have a difference between income tax expense and income tax payable. How do we record that? On our balance sheet. And that's what, as you see there on the screen, that's really the first third of this book, or first third of this chapter that we're looking at, is these items got future taxable amounts and future deductible amounts. Now, future taxable amounts means that I'm going to delay paying tax. One of the primary ways that companies delay paying tax is they use an accelerated depreciation method. Accelerated depreciation method, you've had income tax, personal income tax class that you have to take to get your undergraduate degree. You recall that MACRS, M-A-C-R-S, Modified Accelerated Cost Recovery, that method has accelerated depreciation. So the difference between accelerated depreciation and straight line tells you that what? You're delaying paying tax. Most companies use straight line depreciation for financial reporting purposes. And then they'll use MACRS, they'll use some accelerated, some declining balance method to have more expense now on their income tax, which means they have less income, which means less income tax payable. And so that's a prime example of a difference. And that difference has to be recognized as a deferred tax liability. It's a liability account, maybe short-term, maybe long-term. We'll get to that later. But a deferred tax liability. On the other hand, this second topic here, you see there are future deductible amounts, all right? Deferred taxes, future deductible amounts. That is for when you're paying more tax now and less tax later. Now, what situation might that be? Well, it could be revenue recognition. Maybe you're using the percentage of completion revenue recognition for a contract, so you recognize that as the let's take for example the football stadium here at ETSU. Maybe they used a percentage of completion. Burwell Construction, I believe, who the contractor was. Maybe they use percentage of completion as they go, which kind of mirrors what you would want to do with GAAP, but they may use an installation method or completed contract method where they don't recognize the revenue until the end. So in that case, we see a deferred tax asset may occur. More specifically, it might be easier to get your arms around would be warranty accruals. You know, we had warranties back in chapter 13, and the warranty accrual there was something that we had to accrue based on the accrual basis of accounting. The accrual basis of accounting required that we accrue the warranty in the period that the sales occur. Well, the IRS won't allow that, and as a result, that is something that is not deductible. So if it's not deductible, that means you have to record the expense when the cash goes out the door, because the IRS is all about cash basis. The same is true if you look at your W-2 that you get each year. Everybody's working on their taxes right now, and your W-2 is not based on when you earn those wages. It's based on when were you actually paid. And that's what's on your W-2, because that's what the IRS cares about. Same is true for cash that's received in advance. If you receive cash in advance for maybe a 3-year subscription or 5 years of tickets to some football game, that entity that's receiving that cash, they've got to report that as earned income, not earned income, but taxable income, because they have to pay tax on the cash received. Now those are examples. Specifically, that's going to mean we're going to what? We're going to have more income tax paid now and less later. Well, that's a deferred tax asset. Deferred tax asset. So you got deferred tax liability when you're going to pay the tax later. Deferred tax asset, you're paying the tax more now and less later. So the deferred tax asset and deferred tax liability both are going to be zeroed out as time progresses. These are temporary timing differences, temporary, not permanent. There's also valuation allowance. Well, that's neatly right underneath deferred tax asset, because anytime you got an asset, you have to ask yourself, do I need to have a valuation account? Meaning that I may not get to use that deferred tax asset. There may be some question that the company is going to be an ongoing entity. If that's the case, then you need to have some percentage of that deferred tax asset offset by this valuation allowance, which is a contra account. It reduces the asset. Something they don't point out here in the overview is what's called a permanent difference. Now, there are situations where you have a permanent difference between income tax expense and income tax payable. And when you have a permanent difference, you have to handle that differently. And that deferred tax asset, deferred tax liability would not be in play, because those are accounts that have to be zeroed out by the end of whatever that time is that it's been deferred. But with a permanent difference, and let me give you an example there, would be something like municipal bond interest. Municipal bond interest is fairly non-taxable. So that is income, that is revenue that's been booked, but on the other side, this is something that is not taxable. Well, there's never going to be a reconciliation between the two. So we have to handle that differently. So you got deferred tax liabilities, deferred tax assets for temporary differences, but then for permanent differences, we have to handle that a little bit differently. The second part of this has to do with accounting for net operating losses. Now, the laws have changed for that. We go back here and look at, if I can toggle out of this, this is sometimes, there it is. If I go over here to something that I posted on D2L, and you can see it there on the screen. It's been out there about an hour ago. There's a website here that I've got a link to that talks about the change in the tax law for 2018 and forward. Now, this is something Trump came up with, President Trump came up with, the tax incentives in general. But interesting enough, what has happened that is different from the textbook is, well, let's just click on there instead of me just talking to it. This particular website does a good job of very succinctly describing that. You can see the date here, so 2018 and forward. Again, this isn't in your textbook, because the textbook will say the NOL, when you have a net operating loss, right, you don't want to pay income tax for quite a few years. Well, up until 2018, you could go back 2 years. And the book explains it that way. The My Accounting Lab explains it that way. You go back 2 years. And then if you still have a net operating loss, then you go forward 20 years. Well, that's changed. You no longer can go back 2 years and forward 20 years. It's right there in this first paragraph. We go all the way to the bottom of the page. They describe here as well that the new law also changed the rules on carry forward. Their 20-year limitation was eliminated. So in essence, what has happened where, and maybe I can write here on this notepad, try that. Here we go. These are new tools for me. Good thing about this is you can go back and rewatch it or rewind it, find out what all the mistakes are that I made, right? But when you look at NOL, that is net operating loss, right? Net operating loss, we have a loss in a particular year. Used to be you could go back 2 years, and that's assuming that you have income, right? Taxable income. And if you had any left from this loss, like if I lost, let's say I had $100,000, do that again. I had a $100,000 profit 2 years ago, then I had a $200,000 profit. Then all of a sudden I have what? A $350,000 loss. Well, I've already paid income tax on this and this. I need to go back and get a refund, right? A refund. 300, that leaves 50,000 going forward. With that 50,000 credit, you want to use that, would be taken against income for what? 20 years. That's what it used to be. That's what the book explains. But now this is all changed, and I'll just clear that off since I don't have the luxury of a big whiteboard, right? New law says if you have a $350,000 loss here, now I just go forward for however long, and the change also says I can only go against 80% of net income. That is not in your textbook. That is not in Pearson, not in the PowerPoint. So make sure you understand that. And when we work these exercises, and I plan on doing another one of these recordings using this notepad to work these exercises for you to see. I probably won't work as many because it won't be as necessary, since if I work one particular problem for each type, then you should be able to repeat that and understand what's going on. All right, so let me go back to the PowerPoint here if I can find it. Okay, so again, let me make this larger. That's the loss carry back, carry forward, and so forth. Financial statement presentation. We'll talk about, deferred tax asset's an asset, right? Deferred tax liability is a liability. Pretty straightforward. Income tax expense, income statement, accrual basis accounting, income tax payable, get what you're paying the IRS, balance sheet. All right, so let's go ahead and go through some of these slides. I don't want to make this too lengthy. Good slide there. Income tax expense versus income tax payable. Get that in your mind. If you see expense, now we're all about the accrual basis of accounting. Remember back chapter 13, very simple. That's what we're recording. It's going to go to my income statement. Income tax payable, again, this is part of the accrual basis of accounting, but if you're going to pay more income tax, then you're actually showing as expense. Obviously, debits don't equal credits, do they? And therein lies where you're going to have either the deferred tax asset or deferred tax liability. Financial statements versus tax returns. See, that is not equal to? Almost always they're different. And the fundamental difference is always going to be, for most companies, you're using straight line for financial reporting. You're using some accelerated depreciation for tax purposes, for tax depreciation as they call it. Very common. Because you want to pay tax later, not now. Time value of money says pay it later. But over time, again, it's a temporary difference. Temporary. Well, make sure you understand that. Let me see if I can toggle out of this again and go back to the notepad. Maybe. There we go. Let me clear the screen. Make sure I don't fat key the wrong thing. Then we're in trouble. I'll have to start over from the beginning. In deferred tax liability. The ETL. Got to have a credit balance, right? It's a liability. Deferred tax asset. The ETA. It's an asset. Got to have a debit balance, right? The initial entry. You never start out with a debit entry to deferred tax liability. You're not going to start out with a credit entry to deferred tax asset. Now, as over time, you are going to make those entries because, like most things, this has to be zero over time, whether it's a 2-year, or 3-year, or 4-year, whatever it might be. It's the same thought process. A lot of the stuff we've done this semester is no different in this tax chapter. And the fact this is an asset, that's where you have the valuation account. The valuation account is going to have what? A credit balance. Because that's a contra account. Valuation account, it is a contra account. All right, offset deferred tax asset. Don't worry about deferred tax liability. Liability is what it is. You're not going to reduce a liability, but a deferred tax asset, even though you've got this deferred tax asset that you're going to get this tax back later because the accrual basis of accounting is different than the tax-based accounting, this valuation account is going to offset that, much like what? Accumulated depreciation. That's the most common contra account of all, as a credit balance. Offsets that on your balance sheet. So make sure you understand that. And these are for temporary differences. Temporary differences. Both of these, right? Temporary, it's a permanent difference, it's a whole different story. And we'll look at that here in just a moment. All right, going back to the PowerPoint. Get that thing out of the way, whatever it is. Here we got an example of a company that's got revenues of 130,000, expenses of 60. They make it simple, 3 years. But the taxable revenues were what? 100,000, 150, and 140. What does that look like? Well, that's a very good slide there. And again, this is chapter 17, even though the lower left-hand corner says 19-7. That's because it's from another textbook. This is much better than what Pearson has. So you see there for those 3 years, making it very straightforward from a GAAP standpoint, you can see over time that my income is what? 84,000? Or excuse me, my income tax expense is 84,000. My income is the same. What about down here under the tax reporting? Here I've got less revenue, don't I? That I'm not reporting until probably the end, which would be what? Maybe completed contract, or who knows how they come up with these revenues. We don't know. Maybe it's cash basis. Of course, cash basis can be a deferred tax liability or deferred tax asset. But anyway, just in broad sense, here you got 100,000, 60, 150, 60, 140. See, over time, 390 is equal to 390, right? That doesn't change. And look at the income tax payable over time. So 84,000, that is a temporary difference. You're going to pay the same amount of tax. That's why it's a temporary difference. But look what happens year to year. Look, the first year, you're paying 16 versus 28. The next year, you're paying more, right? And the next year, more again. But over time, they're the same. Very important. Very simple. And they show you that here in this reporting requirement. Where if you're paying more tax later, right? If my income tax expense is 28, but I'm only paying the IRS 16, then I got $12,000, right, in 2014, I'm going to have to pay later. All right, so if I'm paying it later, right, liability, pay it later, accrual, 12,000. All right, deferred tax liability, then it's going to go down by 8,000, and then it's going to go down by 4,000. All right, so what's that look like on my balance sheet for that first year? Well, I got income tax payable, assuming I haven't paid it yet, of 16,000, and then I got 12,000 of deferred taxes, deferred tax liability, and then my income tax expense, there's 28,000. Very straightforward, right? And you can see over time that deferred tax liability is going to be zero, right? Go back to this notepad again, 12844 or 1284. Let's see here. I just know I'm going to fat finger this in a minute. Thinking T account. You know how much I love T accounts. Deferred tax liability. What did we say that was? 12,000. And then the next year, was it 8,000? And the next year, 4,000. So after what? End of the third year, that's 2014. There's 2015, and there's 2016. So you can see that liability is going to zero. Hopefully I didn't get those reversed, but you get the key, you get the gist of it, right? 12,000 offset by 8,000 and 4,000. All right, I always like to show the T account because that's very important. Back to the PowerPoint. Here's that little thing again. 1284, I did get it right. Hallelujah. All right, so that's a very straightforward example of a temporary difference. I can't emphasize that enough. These are temporary differences. All right, again, they're kind of showing you here what I've already talked about, what the future taxable amount. That's the deferred tax liability. I mean, I'm going to kick the can down the road and pay the tax later. You don't want to pay the tax now, do you? Pay it later. Future deductible is what comes our way when what? Something's not allowed to be deducted. Again, like warranty accruals, or we have to pay income tax on cash received that hasn't been earned. IRS doesn't care when it's earned, they just care about when you receive it. All right, so there again is the example we just looked at, the difference, 12,000, then 8,000 came out of it, then 4,000, but over time it's zero. And there's the journal entry. I know you were waiting on the journal entries. Income tax expense, 28,000, very simple, what we've been doing for 2010, 2020, 3010, income tax expense. If you didn't have any timing differences, if you're using straight line depreciation for both, or maybe you're using accelerated depreciation for both, you can do that under GAAP and under, of course, the IRS. If that was the case, it'd be simply income tax expense 28,000, income tax payable 28,000. Very simple. But things aren't simple in business. And here we see that we're going to have income tax payable, meaning that's what I'm going to cut a check to the IRS for, 16,000, and the difference I have to account for because I'm going to have to pay it eventually. That's 12,000 has to be set up as a liability. If you're starting to like tax, it's not quite as bad, is it? All right. There's the second year. Again, you see the deferred tax liability. If you go back and look at that T account I set up, the 8,000 is reduced into 12,000. Now you got a $4,000 balance, right, in your deferred tax liability after 2015. And then after 16, they don't show the entries, and they ought to really move that 2015, 2016 down, right? There they show that over that 3-year period, it's zero. So that's a deferred tax liability. What about a deferred tax asset? Use an example here of warranty cost. Remember that from chapter 13 in the exam? We had an estimated liability for warranties of $500,000. We're required to do that. You got to recognize the warranty expense in the year in which you made the sale. You've heard all those examples I used about batteries at Exide and selling batteries with 2, 3, and 5-year warranties on them. Well, that's recognized as an expense when you sell the battery. A percentage, whatever it might be. But for the tax return, you're not going to be allowed to take that warranty tax deduction because it's an estimate. It's not cash-based. So what do? Well, if you got $500,000 in what? Expense that you're going to have to add back to your income tax books. I mean, think about it in terms of you got your financial statement books and you've got your income tax books, right? You do have 2 sets of books going on at once. Same set of statements. That's what this DTA and DTL is. So here we've got a $500,000 deduction that is going to be disallowed. So we're going to have to pay the tax now and get it back later. $250,000 the next year and $250,000 the next. If it turns out that that's what the actual cash-based warranty costs are. Clarify that. All right. So here we've got what? I guess they don't actually show the journal entries. They do have one here that they accrue a loss from a related liability of $50,000 because of pending litigation. Again, there's another Chapter 13 question. Well, if that's not allowed under income tax laws, right? If you have to pay, if you're not allowed to deduct that expense, then in essence we have to add that back, don't we? And so that's going to boost our income, right? If we're disallowed on that. So we got $20,000 deferred tax asset. Well, let's see what that would look like. My income tax expense is $80,000. My income tax payable is $100,000 because again, that $20,000, the tax effect of that is not deductible. Litigation. It may or may not happen. I mean, of course, you've made the accrual based on your expectation that you're going to have to pay it, but not on your income tax forms and so forth. Again, it's cash basis. Remember that. So here we've got income tax expense, $80,000. The deferred tax asset of $20 because what? We're going to have to pay that. We're going to have to pay that now instead of later. So we hope to get that deferred tax asset back later. Now, if you've got a going concern issue, that's where you may have a valuation allowance that offsets that deferred tax asset. All right. So here, again, we've got another example here, $160,000. The next year, there's that $20,000 deferred tax asset coming, and they're making it simple, saying it was exactly that particular situation, that litigation was exactly 40% of that $50,000. So they're saying they actually had a bill of $50,000 that they paid. So now we get to take that $20,000 out of that. We've already paid the income tax payable for that, right? But we recognize that income tax expense, correct? $160,000. All right, so there's an example of deferred tax asset being zeroed out. And there's the T account. Although it'd be better if they would lower that 2015 line down one, right? Look a little bit better, at least if I was doing it. Gotta make it simple. So now that's zero. I just realized if I had a white screen here, I wouldn't have to toggle back and forth to the notepad. Interesting. Okay, now they're talking about the asset valuation. What if you're not a going concern? You know, that's one of those, you know, those 11 or 12 principles, guidelines in that PDF I keep talking about, the last 5 of which you have to write a paper about, the gap paper. I remember those, what, materiality, conservatism, revenue recognition, matching principle, and consistency. Was that 5? You know, one of those I didn't talk about in there that is very important is going concern. Is your business going to make it? You know, right now in the stock market, you can tell there's some companies aren't going to make it, or else that's why their stock is really bottomed. Terrible, like Occidental Petroleum. Some of the airlines, unless they get bailed out, are probably not going to make it. Now that's where any of these assets you have valuation allowance for a deferred tax asset, because a deferred tax asset says I'm going to have income in latter years that, or future years, that I can take that deferred tax asset against it. But if I don't have any income, then I need to make a valuation adjustments. It's like inventory, your net realizable value offsetting your inventory balance. Allowance for doubtful accounts offsets accounts receivable. Loan losses. Allowance for loan losses offsets your what? Loan receivables. A lot of valuation allowance accounts to make sure your assets are not overvalued. So gap here says they use a more likely than not. Again, it's a gray area. That's where you're going to refer to consistency, and probably your external auditing firm is going to give you guidance for something like that if you're in that situation. But this example here, kind of lengthy. We'll kind of skip through that so I don't keep talking indefinitely. I'm not sure how long this has been going. I don't see a clock on here. But on your balance sheet, if you got a deferred tax asset, if you have some question that some of it's not going to be able to be used at some point in the future for income, then that $30,000 needs to be booked to show on my balance sheet a deferred tax asset of a net $170,000, correct? And there's the journal entries for it. $30,000 offset that $50,000 deferred tax asset. So 30 from 50 leaves you what? Should leave you 20. All right. Most of this I've covered. This is an important page right here that Pearson does not have. I'm not sure why. We'll look at some exercises that I will work here in the next video that shows a basic income statement. Now, in the old days, this was, or not the old days, in prior classes, you probably were just concerned with this column here, which is really the, I always like to call this the gap column. That's just Joel Fadley's terminology, right? That's what this column is. I like to call this the IRS column. That's not official, but if it helps you learn and remember, that's good. What you have here under the gap column is just your basic what? 130,000 revenues. If you remember back to that first example several slides ago, 130 minus 670,000. Again, gap, income tax expense, right? 40%. That's 40%. 42,000 net income. But we need to account for what's going on with the IRS. That's where this must equal that. All you're doing is breaking that out. Well, what does current and deferred mean? Current, and I'm almost hesitant to do this, but in reality, it's income tax payable. Right, 16,000. Back up to those other slides and you'll see that. So what does that leave? What's deferred? Well, that's the sum of your deferred tax liability and deferred tax asset, whatever those are. In this example, you only had one, right? It's deferred tax liability. But what you're doing there is breaking out that income tax expense into what is current, meaning what am I going to cut a check for, even though it's a balance sheet account, right? And what is being deferred. Because the netting of those two tells you what your expense is, 28,000. Very important. I know I've given this on exams before, and people get confused because, I don't know, if you don't do anything else, these two have to equal that. And a lot of people turn that in and they don't. But remember, that's your financial statement column. That's your gap column. This is your IRS column. Very important that those sums must be equal to 28,000. Doesn't get any more difficult when you have both deferred tax liabilities and deferred tax assets. You're going to have that. That's just typical. And you net those two together. Now, it may be a negative or it may be a positive. Don't get all caught up in this is a negative or positive. What's important is you know what your income tax payable is. You know what that is. Then make that your what? My favorite word. Plug. Right? It's got a balance. Okay. Great thing about this, you can go back and watch it again later. Now they kind of talk about what are the differences. Now that we've talked about how to do it, almost like putting the cart before the horse, but what are some of these differences? What would make a deferred tax liability? And I've already talked about this quite a bit, deferred tax asset. Taxable amounts in future years. You know, I misspoke earlier, this number 2 here. Well, first of all, this number 1, sales accounted for on the accrual basis for financial reporting on an installment cash basis. And this second one, that example I used earlier for deferred tax asset, that was actually a good example for deferred tax liability. You go back to the very beginning, because I'm not going to go back and start the recording over, but I'll be honest with you, I did misspeak about that. That's what happens when you're up here talking and you don't have any notes. Teach it from the heart and memory. So what you're doing there, 1 and 2 both, if you're, and you may not even have percentage of completion and completed contract in your 3010, I don't know, in your revenue recognition chapter, it's in there. But both of these, if you're what? If you're going to use completed contract method, you're delaying what? Revenue recognition. Well, if you're delaying revenue recognition, and that's just like macros and depreciation, you're kicking the can down the road to where you're going to have more tax later. Well, that's a deferred tax liability, all right? One is the same way. Sales account for on an accrual basis and on an installment cash basis, right? Installment cash basis or completed contract, both those are very, pushing like the football stadium I was talking about, pushing that to the end for tax purposes. Yes, deferred tax liability. Taxable amount in future years, these are deferred tax liabilities, right? DTL. I'm not going to ask you to list anything like that on the exam. They're just giving you examples. Expenses or losses here, again, that's the one that's more common. Deductible amounts in future, so these are deferred tax assets, aren't they? Let me back up the screen again. Well, that's revenues or gains. Tax amounts in future years. I'm not sure why they do it in that order. But this next page here, these are deferred tax assets, product warranty liabilities, because you're making warranty accruals, but the IRS requires cash basis. Estimated liabilities, litigation. We had an example on litigation, didn't we? Warranty liabilities. Those are DTA. These are deferred tax assets. We're paying more cash now. Or paying more tax now. That's why we hope to get it back later, correct? Those are the main ones. The next one, deductible amounts in future years. So now they're talking about deferred tax assets for revenue, right? Subscriptions received in advance or advance rental receipts. Bristol Speedway, they're still getting what? Revenue for next year's races, albeit a lot less, or maybe UT football games or ETSU basketball. They receive cash now for a 2021 game. Well, of course, that's different. ETSU's fiscal year and UT as well is June 30th. So cash received now, like for this fall, that's deferred tax asset. Of course, they don't pay taxes, do they? But if you had like a Bristol Motor Speedway, thinking through this, Bristol Speedway, which is taxable, then cash they receive for tickets now for next year, I don't know what their fiscal year is, but next year that would be taxable now and use the deferred tax asset next year. Subscriptions, like a 5-year subscription to some magazine, advanced rental receipts. We don't worry about that. Prepaid contracts received in advance. Cash you receive is taxable, but it's not showing up as revenue on your books, correct? And then now they go back to, I don't know why they do it this way, deferred tax liabilities, depreciable property. All right, macros, straight line. Most companies, again, I've said this several times, most companies use straight line depreciation for GAAP. And then they use macros for what? Income tax. I think you had macros in your tax class. A little bit of that, even though it's personal income tax. So they just give you some examples there. Hopefully that's somewhat clear. But again, I misspoke earlier, and I kind of caught myself after I said it. I guess trying to get used to this. Those two, at the deferred tax liability. It's hard talking here with nobody sitting here listening to you and nobody looking at you. All right, so now it brings us to permanent differences. Permanent difference. Well, if it's a permanent difference, do not use DTL or DTA. Don't use it, because if it's permanent, it's never going to reconcile itself. So if you put something out there as a deferred tax liability or deferred tax asset, it's a permanent difference. It's there for eternity until the company closes. So we don't use that. You may think, well, that sounds easier. Well, it is, in a sense. What are some permanent differences? Well, they're municipal bond, interest, fairly tax-free. That's why people invest in it. Usually older folks will invest in that because, or retirees, because they don't have to pay income tax on it. Now, the interest rate is usually lower unless it's risky, and then you get a higher rate, but then you run the risk of it being foreclosed on or lose your principal, and you don't want that. Proceeds from life insurance and premiums paid for life insurance. Those are all federally non-taxable, so that's a permanent difference. Permanent, right? Permanent. The rest were temporary. So municipal obligations, that's interest. Federally tax-free. And the other one that's very common next to that are fines. Think about it. If you're fined, if you're a company that has an EPA violation or OSHA violation, you're fined for that. You also have to pay cash for it, correct? But, and obviously your income tax expense seemingly would be lower because of that expense for a fine, but the IRS is not going to allow you to deduct that. So in a sense, you have to add back that fine. Well, you do have to add back that fine to your federal income tax forms, your corporate reporting, which means you have to pay tax on it. Well, if this is permanent, then what do I have to do on my income taxes? Well, or excuse me, on my GAAP statements. Well, in a sense, you've got to what? Take out that deduction. And we'll see how to do that here, probably when we work the exercises. So that's not a DTA or a DTL. This is a permanent difference. So you have to make income tax expense equal income tax payable. You have to make them equal because it's permanent. All right, so here's a little illustration. You can do this on your own, but I'll just go through it real quick. Macris depreciation, used for tax, straight line for financial reporting. Very common, very common. So that's the deferred tax liability. They use a lot of different terms. Future taxable amount, that means deferred, you're deferring the tax. What about the next one? Future deductible, that's the DTA. Collecting rent in advance, it's taxable because it's cash. Exempt income, so that's permanent, right? No DTL, no DTA. Guarantees and warranties, DTA. Future taxable amount for installment sales, DTL. And life insurance, permanent. Well, we need to write anything, it's permanent. Of course, they have that up here at the top. All right, here's a good example because this has what? This has a deferred tax asset, deferred tax liability, and a permanent difference. If you understand this, I won't say you'll make 100 on this part of the exam, but if you understand what's going on here, you're probably on the right track. So what we have here, and we'll work these on this screen here in the next PowerPoint or the next video, so you'll have a pretty good idea of what's going on. So let's see what this looks like. You got depreciation on the tax returns greater than depreciation income statement, 16,000. But that's the amount, right? So we have to take the tax rate on that to get the actual deferred tax liability. Because when you see that, you automatically start thinking, well, that's going to be a liability, right? I don't have to pay it later. All right, what about rent collected? Automatically thinking, well, if it's rent collected that's not been earned, I got to pay tax on it though, so it's going to be deferred tax asset. And then because it's a fine, that should tell you that's what? That's permanent. That's supposed to be permanent. All right, so tax rate's 30%. There's no deferred taxes at the beginning of the year, to make it simple. I'm not crazy about the way they show this on here in Wiley, but in essence, what you're trying to do here is determine my financial income is $80,000, right? That's my net income. All right, net income's $80,000. The tax depreciation, again, if I'm going from GAAP to the IRS, that's the order. You should always go in. What's my financial income, GAAP? How do I get to my taxable income? How do I get from my book to my taxes? 80,000, there's my excess tax, 16,000. Tax depreciation, 16,000. Again, accelerated. So that's a deduction, right? Deduction to get to that. Excess rent, I am going to have to pay tax for that 27,000 that's not in that, right? Because what would that journal entry have been? Cash. Remember unearned revenue for 27,000? That's supposed to be 27,000 journal entry there. That's what journal entry is in there. So I've got the cash, and this is on my balance sheet. So that 27,000 there, I need to add back to my GAAP to get to my taxable income, right? Same thing with the fines. What did that fine journal entry look like? Well, that would have been, I don't have room to write on here. If I put it out here, fine expense, 11,000, and then cash or accounts payable, 11,000, debit, credit. Well, I've got to add that 11,000 back because that's not allowed to be deducted. IRS, EPA, OSHA, they all work together, don't they? So I've got to add that back. So my taxable income then is $102,000. Tax rate's 30%. So I got to write a check to the IRS for $30,600, and there it is. Income tax payable. Goes to accounts payable. They got the tax forms, everything there, the supporting documentation. All right, so how do we get these other numbers? Well, if I've got tax depreciation of 16,000, right? And the tax rate's 30%. If I was doing this myself, I would just multiply by 30%, right? And that gives you that. I'm not sure why they go this way. They almost make it too complicated to be something so simple. But 16,000 times 30%, that's going to be $4,800. That's the difference. That's the taxable difference, right? 4,800. There's my 4,800. Then I've got 27,000, right, times 0.3. Get those things. Times 0.3 gives me what? 8,100. So there's that number. You can make that what? Your plug number, income tax expense. It's not 30% of that, is it? What's 30% of 80,000? 24,000? You put 24,000 there, things out of balance, right? 30% of 80,000, that's the tax rate, right? That's what we've been doing, but this, because of this permanent difference, makes this a little bit more complicated. So how do you get 27,300? If you don't want to use that as the plug, which some people don't like that term, well, you have to basically take what? 80,000, add back the 11,000, which gives me what? 91,000 taxable income, because in a sense, since it's permanent, I've got to add back the deduction to get my taxable income, excuse me, financial income, GAAP income. So 91,000 times 0.3 will give you 27,300. You don't have to do that, but if you want to understand what's going on, think about what you're doing. If it's a permanent difference, right? 80,000, add back the 11,000, right? Just like we're adding the 11,000 to this. If we're adding 11,000 for taxable income, we got to add the 11,000 to the GAAP income, or else this thing's not going to balance. So that times that is 27,300. All right, we'll work some other ones of these on in Pearson and probably supplemental so that you can see what's going on there. That's a good example. I don't particularly like the layout. I like the layout from top to bottom, but going this way, I just don't like, I don't know why you have to go this way and down. I mean, you should know that these are what? What's the deferred tax asset? What's the deferred tax liability? All right. Various tax rates here. Tax rate change on deferred income. Keep the key phrase here that's not in the Pearson, not in the Wiley, because this is the Wiley PowerPoint. What's not in the Wiley that Pearson has is they talk about varying tax rates that vary from year to year. The important term, and we'll look at that when we look at the exercises in Pearson, is enacted tax rates. Enacted. You won't see that in these PowerPoints, unfortunately. Enacted tax rate. That's what's important. You always want to take the enacted tax rate for that year in which that deferred tax asset or deferred tax liability is going to be utilized. But that's not, we're not going to overthink it at this point. Just keep that in mind. I want you to get the basics. I want you to get the intermediate level accounting here in this class. I don't care about average tax rates at all. So don't worry about that. I know it's there in blue, but don't worry about that. That's just a number. It's just a calculation. And I probably should have put enacted tax rates on this particular page. Future tax rates. All right. Loss carried back and loss carried forward. I've kind of explained that already, so I'm going to kind of skip through this part. Got some good graphics, though, a lot clearer than what I did, right? There's your what? 2 years going back, 20 years forward. But then, under Trump's 2018 tax law, that's gone. And now you can go forward for infinity. That's what's changed. Loss carried back, carried forward. So carried back, in the old days, you could go back and get what you've already paid, right? It's a refund for 2 years. You don't get refunds anymore. You go forward. But it's a carry forward, and again, it's 80%. Left that off. It's 80% taxable income. You can't take it all. But you can go forward however many years it takes. I always thought that was kind of unusual because if it's Trump's Tax Act, I would think he would be pro-big business, but this would tend to not help big business. I don't know. That's something interesting. Carry forward, right? Back 2 years, 420. You used to have the option of not going back. Of course, I don't know anybody who didn't use that. And then going forward 20 years. You had that option in the old days. You can either do that or you can do that. All right, so to see what we did in the old days, this is 2017 back. What if you have a loss here of $480,000 after you've made money the last 3 years, right? And the enacted, that's the key term. I guess Wally does have that here. Enacted tax rate is 29%. What entry did we make? We click all these cells. We're tooling along. There's my taxable income. Taxable income. I'm paying a lot of income tax, right? Right here. Boom, I get to 2015, $480,000 loss. I can go back 2 years. I can't go back to 2012. Go back 2 years, and I got 325 out of 480. And then to get up to what, 480, I can take another 155. So that plus that is equal to that, right? 325 plus 155. But I go back 2 years, use all of it, 30%. So I'm going to get a refund of 97.5, right? Right there it is. And then I'm going to get a refund of 30% of what? 155. And so that's, did I say that right? 30%. Oh, that's the revision. Kind of unusual how they're doing that, but that's in essence what? 30% of 155. It doesn't really say that there. They're multiplying 30% by 245, which would have been my adjusted income tax forms reporting. And that says my tax should have been 73.5. Well, I paid 120, so 120 minus 73.5 is 46.5. So I'm expecting a refund, not a tax credit for the future, I get a refund of $144,000 in the old days. It's worth remembering what we did in the old days, because you're going to get a job here in the next year or so. That's probably going to come up. So you probably ought to understand how to work a problem if it was a carryback of 2 years. All right, so we expect a refund of $144,000. So my journal entry went too far. Income tax refund receivable. Receivable means I expect cash. And then, which is a balance sheet account, correct? And then I've got this benefit due to loss carryback. That's the income statement. Income statement account. 144,000. So that's going to be what? A credit. Anytime you got a credit to revenue or credit to like a gain, benefit due to loss carryback. Pearson uses a different term here. I can't remember what it is. I think it's called income tax benefit. Every company has a different title, but it's a income statement account. I think that's what my accounting lab uses. I expect a refund, and they made this very simple that there was no carry forward, right? Now, we got one here. It's going to be a carry forward at some point, and here it is. So here we've got 350,000. I don't know why, but they grouped that as 2 years. So they're saying you're going back 2 years. You don't have to worry about 2011 that might be out here that you would what? You would ignore. So 350, I get a refund, what? Of that entire 140,000. But then I still got what? 150,000 going forward. So 40% of that 150, what's that going to be called? Like a credit for future income. Credit, what's that sound like? That's a deferred tax asset. Use that same account. There's the journal entry. There's 140,000. Again, receivable. I expect cash from the IRS. Everybody loves to get cash from the IRS, right? And there's my benefits going to my income statement. And then where's my carry forward? There it is. Deferred tax asset. It's not going to give me cash for something that I may or may not earn in the future, right? Because that's going to be out here somewhere if I have income. If I have income. And then that's going to my income statement as a benefit due to loss carry forward. Again, Pearson and the exercises there, they don't use this loss carry forward. They just call it income tax benefit. And that's fine if you want to use that. I don't particularly like it. Either way is fine on an exam. Income tax benefit. Income statement. That's balance sheet, right? BS, balance sheet. And then I like how they do this. There's some question about the ongoing ability of this company to stay in business. If there's some question about that, going concern, question, right? One of those 11 principles, guidelines that you're looking at. That PDF out there and talked about the first day of class. They're saying there's some question about this company's going to make it, so they're going to take what? The entire 60,000 off. So those two cancel each other out, don't they? You still have that on your balance sheet, but now we've got this contra account, don't we? Which in fact, your balance sheet's going to be what? Zero for that deferred tax asset. It's on there in case you do make money, but you don't expect for it to be, because you don't want to have your assets overstated. How many times have I said that this semester? Whether you're an auditor or working in a corporate office, it's all about not having assets overvalued. Okay, something else that's changed, and I've got it here on this slide, and I would expect you to know this on the exam. I think there's an exercise in Pearson we'll look at, and of course the Pearson answer, again, is out of date. But when you have these deferred tax assets and deferred tax liabilities, you've got one that's net current amount and one for net non-current. You want to combine, that's the old way. right? You want to combine all of this as one component. Treat all as non-current as one component, whether it's a current asset or whether it's a long-term asset or a long-term liability. That's what it means by non-current. Long-term asset or long-term liability. Again, we got one that we'll look at here in Pearson, my accounting lab. It will show you that. They're just trying to simplify things, right? It's a textbook, even though this was December 15. It's out of date. All right, you can go through there and look at that on your own if you want to. If that helps you solidify your understanding. You know, extraordinary items. I know Ashley says she covers that. Extraordinary items, whether it's earnings per share or income or loss or whatever, that's no longer relevant. That's out. And what we've been doing, and again, number 10 should have been somewhere earlier in these slides, but that's the way the experts put it together. So this is a basic flow chart that shows you deferred tax asset, deferred tax liability. You can see that deferred tax asset, again, anytime you have an asset, do I need to have an offsetting valuation allowance, a contra account? Liability is a liability. And then it shows what you put on the balance sheet and what you put on the income statement. Okay, so that pretty much covers this chapter, I believe. And I'm going to end the meeting. All right, so we'll have another one here I'll put together for the homework. The great thing about this process is you're going to be able to go back and watch it again if you want to, if something's not clear. If after you review this video and have questions, you can email me. I'm not sure I'm going to set up a real-time synchronous conversation. I'll see. I'm going to do something like that with my Mac classes. There's only 9. But I would encourage you to go through this and have somebody say, well, I'm not really sure about that. Email me, and I'll be glad to try to help you. You may want to wait until I do the homework to see if you have questions from there, because I think doing a homework on here is going to be maybe better than what we did in class, since you can go back and look at what I've worked, because I know that's something that people struggle to keep up with me since I'm going at such a rapid pace. Maybe my handwriting will get better here as I go through some of this stuff. But as far as the exams, I'll talk about that later. I'll just mention now, I don't know if we're going to be back in time for April 14th. I have my doubts. And if that's the case, I'll have to do some type of online exams, and I'm leaning toward probably using Pearson to do that. Pearson has the ability for me to set up an exam online that's going to be time bound, meaning you would need to start it at whenever the class period begins, and I would give you an hour and 15 minutes. Obviously, if you're going to use a textbook, I'm not going to know about it. But I would have to have it time bound to where you're going to have to prepare for the exams like you normally do. Because if you think you're going to be able to look up answers or how to work something, you're going to run out of time. So it is going to be time bound. I'll just have to be careful in what kind of questions I ask. And they will be exercise driven, just like the other ones, similar to what you see in Pearson. There's some challenges there with the NOL, because all the NOL problems in Pearson are going to be based on the back 2 years and forward 20. So that's something that we'll probably have to do the exams based on that, even though I'm going to show you what has changed, which is relevant. But it is good to learn the old way. It really is, because you kind of understand where we've come from, what changed, and what the old ones, what was handled, how it was handled in the old way. But these will be online exams that, and I will probably develop maybe 3 different exams similar, very similar questions, and have each, I've got 37 students, 36, 35, something like that. Have 12 assigned to each one of the exams. That way I don't get people sitting together and working on exercises. Because it is all about authenticity, because that's something that's very important. I want you to learn it, I want you to move forward. But as far as being able to keep you from looking at the text, I mean, I could tell people it's not allowed and have the honor system, but I'm not going to do that. I'm just going to have it time bound for an hour and 15-minute exam through my accounting lab, more than likely, and do it that way. I think it's probably the only thing I can do. The advantage of that, if it's going to be Pearson, you kind of know what to expect on those Pearson exercises. Now, there's other exercises in there. Back of the chapter has all these exercises like I assigned. They're very similar, almost the same layout. So there's other exercises there that you need to kind of look at and understand. I know there's a PDF out there as well in the content under this PowerPoint about, if I can pull that up here. I think I need to share the screen though. Yep. Yeah, you should be able to see that now. So if I go back up here to, I'll go back to D2L under content. I've got an exercise out there under PowerPoints, net operating loss exercise, income tax supplemental exercise. Probably just ignore those two. Because again, I don't have any mechanism to test something like that. These are good exercises, and that one actually has the solution. Now it is a go back 2 years and forward 20, which is what Pearson's going to have, but there are some NOL exercises in Pearson. Wiley didn't have that. That's why these exercises are out there. So I feel comfortable with Pearson that you don't, I mean, I could delete this, but I really don't want to. I'm going to leave it there. But those two you can ignore for purposes of this class. We'll get it done through Pearson exercises. But I am sympathetic toward this whole process and the challenges we have. I mean, I know we're all going through this uncertain time. Believe me, I've got a full plate too with elderly parent and so forth, things like that going on, and but we'll get through this and hopefully you'll be able to learn and be ready for advance. I don't want you to advance out of this class into advance and then not know what's going on there. That class will be hard enough as it is. So we'll get there. This next exam, April 14th, we'll keep the same date, the same time. So make sure you're available those days. The rest of this is pretty much asynchronous. You watch these videos whenever and as many times as you want, the homework as well, but we're going to work through all of that. So have a good day. Let me see if I can stop this thing somewhere. There it is. I'm going to end the meeting now, and we'll see you soon.